Okay, are we ready?
Yes, we are.
Okay, very good. Well, welcome everyone. Welcome to Monarch Mortgage's LA City LIPA and MyBook program. Tonight we will be focusing on the down payment assistance. So what is Monarch Mortgage? Monarch Mortgage is an independent mortgage brokerage located in Los Angeles, California, and approved to offer residential mortgages throughout the entire state of California. Monarch receives wholesale rates through over 40 approved banks that help their clients save $8,000 on average instead of working with a direct lender. We have fast term times, great service and technology, and we can close. Next. Okay, so here we have some introductions. Carlden.
All right, so everyone, this is Carlden Lainfiesta, also known as the Mortgage Fiesta, partner, owner, and also mortgage consultant here at Monarch Mortgage. So I'm gonna give it to my partner, Otis Milton.
Good evening, everyone. Again, thank you all for joining us. I'm Otis L. Milton, the mortgage millennial. I don't only service millennials, but that is my generation, and that is the bulk of my business, but I'm absolutely here to service everyone. I am the co-owner and vice president at Monarch Mortgage. I've been in the industry of real estate for 10 years now. I'm serving in multiple capacities, solely on mortgages today.
And once again, hello, my name is Joanne Martinez. I am a senior loan processor, have been in the business for about 20 years, and work very closely with Carlden and Otis to close your loan. So here at Monarch, we have a team of people that are focusing on each and every transaction. We have Carlden Lainfiesta, mortgage consultant and CEO. We have Otis Milton, mortgage consultant and VP. We have William Johnson, which is the loan officer assistant. We have myself, Joanne Martinez, a senior loan processor. Laura Seeger, which is our executive assistant, and Brent Wolf, junior loan processor.
And before we move on, I want to acknowledge, go back real quick, Carly. I want to acknowledge William and Brent. They're not on the call with us tonight, but both of these gentlemen also just passed their test to become mortgage loan officer consultants as well. So a virtual round of applause for the gentlemen. We're not only having a full team, but we want to make sure that everyone that works for our company is growing and gaining in their career in real estate. So congratulations to Brent and William becoming licensed loan officers. Thank you everyone for the virtual claps.
Okay, so programs we offer FHA, VA, conventional, bank statements, 1099 only, W-2 only, no income docs, DSCR, down payment assistance. How can we help you win? We have lower interest rates than retail banks. We can close your loan within 21 days or less. We have great customer service. 30% of our business is actually repeat business. We are knowledgeable, licensed mortgage professionals, certified mortgage planning specialists, and certified mortgage advisors. We speak directly to listing agents to help you sell your loan. We answer the phone after hours. And so far, we have 100% close rate from pre-approved loans that opened escrow to closing in 2022. And I'll pass it on to you.
Sorry guys, I was on mute. So we're about to get into what we came to talk about tonight. What is LIPA? What is MIPA? Let's take a quick poll. Anybody that's ever heard of this program, put a 1 in the chat. I need to make sure everybody's awake. I see I got some ladies here. I see Miss Stephanie's awake, Miss Stacy's awake. Let's see if anyone's ever heard of this program. A 1 if you have, a 2 if you haven't. See what we got. Let's gauge this out. We got one person that's heard of it. Okay, we got some people that have never heard of it. This is great. This is great. Okay, taking a poll, give another 20 seconds. Everybody put their answers in. So far, we have more people that have not heard of it that have heard of it. So this is good. So we're gonna talk all about it. Okay, so we're going to talk about what is LIPA, what is MIPA, right? So there's two different, actually 3 different programs, and MIPA has 2 different tiers to it that we're going to talk about tonight. So LIPA stands for low income, MIPA stands for moderate income, right? So those are your 2 differences, right? And later on in the slides, we're going to cover on what the income looks like for you to qualify for the low income side, and what your income and household side needs to look like to be qualified for the MIPA side, for the moderate income, right? And there's a higher tier of moderate income as well. So we're going to talk about that. So the goal of LIPA and MIPA programs are to assist eligible low to moderate income first-time home buyers securing permanent housing and purchasing homes within the city of Los Angeles, okay? And we're going to talk about that definition because we think of the city of Los Angeles as one particular area of the city of Los Angeles. There's actually 44 communities that qualify as the city of Los Angeles, and we'll talk about some of those communities as we go through. LIPA, MIPA programs provide home buyer program assistance in the form of a deferred payment, subordinate soft second loan for down payment, acquisition financing, and closing costs. Loan funds may be utilized citywide within the city of Los Angeles. Okay. So this is the definition of what LIPA and MIPA is: low to moderate purchase assistance and moderate income purchase assistance. Okay, let's go forward to the next slide. Okay, so LIPA, MIPA, loan funds must be used to assist low to moderate income. So there is an income limit that you must meet to qualify for this, right? So LIPA is up to 80% of the AMI, right? That's the area median income, right? This is actually something that you guys can Google and find out yourself. You can always put in AMI and put in a zip code or a neighborhood or area, and it'll tell you what the AMI is in that area, right? So that's where you fall to be into the low to moderate income. I'm sorry, the low income. For the moderate income, if you're above 80% of the area median income, you're going to fall into the moderate income level, right? So we'll talk about that, and we'll probably show you some examples. But these are very simple tools that you guys can actually Google. If there's an area that you're looking to get into that's on that chart, you can see where you may fall based on the income in that particular area. We can move forward with the next slide. So first, let's talk about let's talk about some of the income limits, right? So, and it goes by household size. So it's a little bit different than some of your other loan programs that don't calculate household size. This particular program does, right? So these are some of the ranges based on the persons in the home and what the income cannot exceed to qualify for that particular program, okay? So on the top here, we have 80 for low to moderate income, low income line here, under 80% of the AMI. We have your moderate tier on the second level here based on home size. So home size are persons that are going to be living in the home, right? Adults and non-adults will have to be factored in here. And the way that they'll measure that is they'll look at your tax filings to see if you're claiming people on your income, right? So if you have 2 children, you're claiming 2 children, that's going to have a household size of 3 if you are a single individual, okay? And then the last line is that higher tier that we talked about, and these are the incomes that will qualify you based on those household size, okay? I'll stop right here because I know this was a lot so far. Any questions so far? Feel free to unmute yourself and ask, or feel free to put it in the chat. I don't see any questions in the chat yet.
I have a question,
Yes,
and it
Ms.
talks
Stephanie.
about the demographics. Are we talking Los Angeles City only? Because I'm in Riverside County.
Yeah, so this particular program is for Los Angeles City, and what Carlden just pulled up here, these are the cities, these are the communities that fall under the city of Los Angeles where this program is eligible. But Ms. Stephanie, we do have other assistance programs that we could talk to you about offline. If purchasing in Riverside County is important to you, I'm closing one right now. I'm in Riverside County on a down payment assistance program. So there are some other programs. Today, this is the LA City program, and these are the communities that factor in there. So a lot of us wouldn't think that Pacoima would be considered the city of LA, right? All of these communities are considered the city of LA, and this program is eligible in all of these areas. Okay, perfect. Thank you for pulling that up, C. We can move forward to the next slide.
Yeah, real quick, just because I know this is a quick snapshot. Can you guys hear me okay?
Yeah.
Yes.
And I apologize because I'm looking over to the right because I have 3 screens over here. So pardon me if I'm not looking directly at the camera. But one of the things you'll kind of notice is that we have Brentwood on here. We have Pacoima on here. Basically, every city in the Valley is on here for those of you that are interested in the Valley. This True City, Los Angeles is on here. Watts is on here. West Adams, West LA, Westchester, Westwood. So almost all the West are on here. So just to kind of give you guys some ideas, I know I saw that Harbor City is on here going to the south. I've also seen, I believe San Pedro, if I'm not mistaken. Yeah, San Pedro's on here. So just to give you guys some ideas of where you can purchase using this program.
Yeah, it's much wider than most people think when they think of the city of LA, in terms of where you can utilize this program at. Okay. All right.
I have a question, Otis.
Yes, go ahead, Vita.
So on the income limits sheet that you have, dependent on where you fit in one of these categories will determine how much you are approved for. Like, so if you're low income, if you're mod income, maybe you're going to get to that. But I just wanted more clarification of, like, depending on where you fall, low income, mod 120 or mod 150, does that mean that you're still eligible? But then maybe it depends on how much you're allocated. How does that work?
Yes, Vita, this is why it's cheating, because you're jumping ahead, but you're right. We will cover some of those things because it also want to factor in to how much cash the particular borrower has on hand. We'll talk about it when we go deeper into some of the additional qualifications. Like, for instance, the borrower is required to use 1% of their own money with this particular program. So we'll talk about what assistance allocation will be available based on those levels. Okay, here we go. So Carlden, I'll let you jump in on this one.
Okay, sure. So if you're low income, essentially 80% up to area median income, you can receive up to $140,000 towards your down payment and closing costs. If you fall within a MIPA 120, which is area median income between 81% and 120%, and just to go back real quick, so for mod 120, for one person, the most you can make is $100,000. For 2 people, 114, for example, right? So if your income is in between this level for mod 120, you can get up to $115,000 towards your down payment and closing costs. Then the last tier, MIPA 150, can give you up to $90,000, which is this last tier here. Now, MIPA 150 is not too far off from 120, so it's not significantly higher, but at least there's this is the highest range you could fall into and still participate in the program.
I have a question, Carlden. I'm sorry.
That's okay.
You mentioned it goes by the amount of dependents or the amount of people that are in your house, and they will measure that based on your tax returns. Is that correct? So
Correct.
How many years tax returns will they be looking at to assess that?
Yeah, so we'll cover that when we get to income because I don't want to jump too far ahead.
Thank you. Sorry.
No, it's okay. I appreciate you. But for right now, since we're on income limits, are there any questions that are related to income that goes in the income limits? One thing I do want to express is that, like, for example, if you have a first and second job, they will look at both of those incomes. If you receive Social Security, foster care, they do consider that income. If you've pulled money out of your retirement account recently, they will look at that as income. So this is the true income limits. Now, if you're self-employed, you have to be very careful not to disqualify yourself because some people might make over $100,000. So let's say you're one person and you make over this $100,000 from mod 120. If you wrote off like $50,000 of your income, you're still within this income limit. So that's one thing I want to make sure we don't leave out self-employed people when it comes to this. But any other questions so far? I'm going to turn to the chat. Joanne, feel free to kind of call them out if you like.
Sure. Let's see, but this is from Otis. The AV is not allowed on this program. It is LA County, not considered LA City. I guess he was responding to James Lee. Is that correct, Otis?
Yes, I was responding to James to let him know that Palmdale Lancaster is not on that particular list, but there are other programs that can be used there.
Perfect. Okay, very good. I think that's all for now.
Okay. Also, this program is going to be good for single family homes and townhouses and condos. So there's no 2 to 4 unit properties allowed on this program. Okay. All right, we're going to move on here. I see questions are coming in. We're going to be talking about income for a little bit on this particular program. Okay, so as questions come up, please feel free to put them in the chat. We'll address them as they come in. Okay, so fund eligible uses. So the funds may be used towards your down payment, closing costs up to 5% of the purchase price, and gap or acquisition financing for the purchase. So for most people, you're looking at it covering the down payment and or the closing costs can be used on this program. For property requirements, we're looking at 1 unit properties only. So once again, that's your condos, townhouses, or PUDs. That's a planned urban development. We also have single family homes on here, manufactured homes on here, but they must be on a permanent foundation and connected to permanent utility hookups. And the property also has to be a standard sale, a bank approved short sale, a foreclosed home, and or REO home. It has to be vacant, occupied by the seller or a caretaker. Property cannot be tenant occupied unless the tenant is the prospective home buyer. So that's pretty specific. It essentially can't be tenant occupied is the main thing you need to know, and it has to be a 1 unit property. Property must be located within the LA city. So you can actually use this website, zemas.lacity.org, in order to figure out if a property you're interested in is located within the city of Los Angeles. If you're old school like myself, I don't still have one, but I used one, the Thomas Guide. Properties located in the white shaded portion or within the city of Los Angeles. And then also we have the handout that I just briefly flashed on the screen, but those that list of communities are also considered a part of LA City.
See, we have one question real quick before you move forward. It's an income question. I'll read it to you. What if your income fluctuates from year to year and your household average could either go above or below?
I hope that made sense.
It did not make sense. I'm trying to interpret it. But give me 1 second. Let me break it down. Because this might apply to everybody, then you can clarify if I answered your question or not.
Okay.
So if your income fluctuates from year to year, so
Yes.
Okay, you know what? Are you a commission borrower, receive bonuses or work like variable, like up to 40 hours, part-time hours?
So I work in TV and film, and 2022 might have exceeded, but 2023, at the rate we're going, it doesn't appear that it'll be anything close to what I was making in 2022. And that's kind of common. It's based on, how the industry is doing, what's happening in production, if you're working or not, because it's freelance.
Right.
So that's my question,
Right.
And that I would ask you one question too, because I've helped quite a few people with similar situation. Some people will be on unemployment during the times and where they're not working.
Yes.
If that is consistent over 2 years in between your gaps, that's income that may be used to kind of offset your difference.
Okay.
But I'll let Carlden finish answering. My answer would be they're probably going to look at an average. So in this case, if you're buying this year, they'd be looking at 2021 and 2022.
Okay,
with maybe a profit and loss statement from year to date to kind of see where your income is trending. And they'll
Okay.
more than likely do an average based on that.
okay, that makes sense. Thank you.
There's nothing else for me to add. Oh, that's great, a great answer. So 2021 and 2022 taxes, they will take an average and they will look at your pay stubs for year to date and also your profit and loss. So I think that that is the correct answer for you. Now, this is Jody, correct?
Yes,
Okay, and then Jody, are you W-2 and 1099 or are you just 10?
only W-2.
You're only W-2. Okay.
Yes,
So yeah, you're pretty much looking at an average
okay.
over the past 2 years. Okay. Now, if
Thank
we do have, like, for example, in 2022, that you were above the income limit, and this year in 2023, you're trending below that income, we can use what you're currently earning to help you qualify.
Okay, thank you.
No problem. Appreciate the question. And
Thank
it's
you.
those types of complicated questions that some people don't want to ask, but I appreciate that question because it might have educated 4 or 5 other people on this call how that would work.
Thank you.
No problem. Okay, moving on from the city. All right, so home requirements. You must be a US citizen, lawful permanent resident, or other qualified alien. You must be a first-time home buyer, defined as someone who has not had an ownership interest in real property at any time during the last 3 years. So if you owned previous or more than 3 years ago, you're considered a first-time home buyer. You cannot have any outstanding mortgage can't talk. You may not have any outstanding mortgage obligations during the last 3 years. You may not have claimed a deduction for the mortgage interest and or property taxes on real property on federal income tax returns during the last 3 years. The total gross earnings must be within the low and moderate income limits as adjusted per household. Okay, so that's pretty much covering citizenship, first-time home buyer, as well as any questions about, how the household income is calculated. Keep the questions coming. I'm going to continue. So borrower must meet the following criteria: occupy the acquired subject property as their primary residence, and also complete an 8 hours of home buyer education and receive housing counseling from a LAHD approved home buyer education provider. So typically, once we pre-approve you for this program, we'll send you a list of HUD-approved homebuyer education providers, so that way you could take the course. We typically don't advise taking the course before we pre-approve you because you may not meet all the qualifications for the program. We don't want to waste your time. So, that's why we would typically go that direction. This is the list here of the 8 hours in case, you want to know what's on it. But once again, I would stress putting your application first, make sure you're approved for the program beforehand. Otis, you want to pick it up from here?
Yeah, I got it. All right, so we're looking at income guidelines. I know it's a lot of it's a lot of information. Y'all might be loan officers by the end of this, okay? But let's take a look at it. So the gross income for all adults 18 or older who are a part of the household must be included. The lender must project the total gross before taxes or other deductions, income and household for the income household for the next 12 months. LAHD averages the borrower's income for the 2 most current months' pay stubs and projects the income forward for the next 12 months. If a verification of employment VOE indicates the projected pay is increased in the next 12 months, LAHD will factor that anticipated pay increase on a prorated basis in its income calculation. So let me give you an example. What does that mean? Okay, so Miss Stacy is slated to get a raise, right? She's applied for this mortgage and she's slated to get a raise in September, right, of 3%. They will look at that rate increase and she has to still then qualify with that income, that increase on her income, right? Based on the tier that she's on, whether that's the low, the mod 20 or the mod 50. Does that make sense? Okay. Okay, great. We can move forward, see.
Team, it looks like Beta's asking if you will check the waiting room.
Oh, let's check it out. We've been talking away. I think Carlden let him in.
Yeah, I let somebody in recently. Hey, they were late to the party. It ain't my fault. I'm just kidding.
And missing his goodness. All right, see, we can go to the next screen.
All right, so real quick before we continue, I do want to mention that this is including the gross income of all adults 18 years or older. That is very important because if you have older kids beyond the years of 18 years old, they will factor their income into the income calculation. So you might have to kick a few people out to purchase a house. Next slide. No, I'm kidding. Hopefully not, but you never know.
All right, so we're gonna look at income guidelines continued. So household size is determined by counting the borrower's independence claimed on the federal tax returns, right? So we are going to look at the tax returns to qualify those other dependents if we're gonna be utilizing them in the family size, right? So everyone is gonna live there, little Timmy, little Tommy, little Keisha, they have to be on the tax returns if we are saying they're going to be living in the home, okay? That is very important to note. Other household members who are not claimed as dependents on the borrower's federal income tax returns must provide supporting documents to prove that they are a part of the household, right? So if maybe you are, maybe you have a foster child and that income is taxable and they're not on your tax return, or not non-taxable and they're not on your tax returns, would show documentation that that child is going to be living with you as they are a foster child. That's to just give you an example of what that means. LAHD runs a credit report of all household members 18 years of age or older who claim not to receive any income, any type of income. LAHD requires that the household members submit a LAHD non-income certificate form and a credit check authorization form, right? So if they have a job, they're probably going to find it. So we can't say that there's no job, they don't have it if you're trying to fit into a box, right? So this is why it's super important when you're meeting with myself, Carlden, or Joanne, we're pre-approving you. I know it may feel invasive, but we're asking you all these questions so that we structure your loan the correct way and we have the least amount of problems as possible once we get you into escrow, okay? We can go to the next slide, see, unless there's something you'd like to add. Okay, next slide. That means nothing for him to add. Types of income that must be counted and included to determine the program's eligibility. So gross wages, salary, overtime pay, commission, fees, tips, royalties, bonuses. Net income from operation of business, profession, business activities and investments, interest, dividends, and other net income of any kind from real or personal property. Social Security, VA compensation, annuities, insurance policies, that should probably say insurance policies with cash value, retirement funds, pensions, disability or death benefits, and other similar types of periodic receipts. Unemployment, disability compensation, workers' compensation, and severance pay, welfare assistance, alimony, child support, regular contributions and gifts received from organizations or from persons not residing in the dwelling. All regular pay, special pay, and allowances for all members of armed forces. Inputted income calculated on assets. So that last one kind of means if you have a large amount of money and it's actually giving you a return on that based on the interest that you're going to be receiving annually, that must be calculated as well. This is a lot, right? So they really want to know everything. Any questions about the type of income that must be calculated? Okay, hearing none, we can keep moving forward. Okay, so income documentation required. So these are for those who are W-2 employed on the first part, right? So 2 months of current pay stubs. LAHD requires the following number of check stubs to be submitted based upon pay frequency, right? So monthly 2, bi-monthly 4, bi-weekly 5, weekly 9. These are the amount of paycheck stubs that must be submitted with the loan application. Current VOE, that's verification of employment with current and past income information. So if you worked somewhere else a year and a half ago, we would also get a verification of employment for the income that you made at that previous job as well as your current new job will get a verification of employment there. This next part is really going to pertain to those who are either business owners or self-employed. Your current year-to-date profit and loss statement. I hope all my business people are doing that. QuickBooks is a good tool. If you're not, that's something that you definitely want to have in order. Dated and signed, wet signed, that means no e-signatures for these. They must be wet signed or live signed for those who are self-employed. And 6 months of statement for all assets. So savings accounts, checkings accounts, CDs, money market accounts, retirement accounts, investment accounts, etc. For all adult household members. So these are your core documentation that we'll have to have in your package when we look to pre-approve you on this particular program. Any questions?
We have a question.
Okay.
Does total income include foster adoption payment from the county? This income is not taxed.
That's a good question. So yes, especially if we're using that income to qualify you, then we're definitely going to have to be able to source it and count it, right? So in the way that in as detailed as the city is with this loan, I would say yes, that needs to be calculated. You should still receive, even though it's non-tax, a end of the year statement. And a statement each year at the beginning of the year to show you how much you will be getting monthly. So that would be the documentation that will require if it's non-taxable and there's no taxes filed on that income. We have some more people coming in.
Yeah, I'd just like to add to that. I think that is covered under number 7 right here, where it says alimony, child support, and this particular part, and regular contributions or gifts received from organizations or persons not residing in a dwelling. So that would probably cover the foster care income. So hopefully that answers the question. Also wanted to just add on to this 6 months of statements for all assets right here. We'll get to it in this presentation, but essentially 6 months of bank statements, they're going to be looking for any income that's hitting that statement that appears to be regular. They're also going to be looking for any expenses that appear to be regular. So just know that they do require statements for all assets, and they're looking for if you have any additional income beyond what you reported on your application, okay? So that's kind of the check for the income as well.
Right, and I'll give you guys a quick example. I had a borrower who would Venmo his daycare person each week, and an underwriter called that out, right? Because that now becomes a monthly expense that needs to be calculated into your debt to income ratio. So that is super important. So hey, know what you're getting yourself into, because they're going to look at it with a magnifying glass, okay? Joanna, are there any more questions before we move forward?
Yes, we do. We have one more question. Is the MIPA max income dependent on the zip code, or is 101,550 the absolute max to be eligible?
For a single person, it is not dependent on zip code. So keep in mind that this is really a LA City program. So it's really goes by if any of the cities are within or communities are within the city of Los Angeles. But they just go off of the household size and the amount of people in that household.
No more questions.
I hope that answers your question. Any more questions, Joe?
Yes, we just got one. Would the rent I write off for my business in regards to my home office count towards my personal income when qualifying for a home loan?
See, you want to take it? You want me to take it?
I'm thinking it through real quick.
Okay, so I'll give you my direct answer. So any expenses that are written off, the income that's going to be used is the income after the write-offs. Right, so regardless of what the expense is, now there are certain expenses on your tax returns that can be added back in as income, and we are not tax professionals, so we can't share those with you. You talk to your tax professional about that. But the answer in my regards would say that any income, your income that's going to be used for qualifying is that written off after what's after expenses, regardless of the expense.
Yeah, also there was an earlier comment. I'm not sure if it was Beta or somebody else that mentioned it. Oh, yes, it was Beta. Thank you, Beta. She mentioned consult with you before filing taxes, and she asked that as a question. Yes, I would absolutely advise if you're looking to purchase a house and you have write-offs, meaning that you're typically self-employed or own a business, you might want to talk to us before you file your taxes, because once you file taxes, there's nothing we can do. So if you made $100,000 and you wrote off $90,000 of it, we have to use $10,000 to qualify you. That's not enough income to help you purchase a home. Now, if you earn $200,000 and you wrote off $100,000, well, you still fall within the income limit, so that would work, okay? So, but those situations are kind of case by case, because you also have to average your taxes over 2 years. So I would definitely advise you to set an appointment with myself, Otis, or Joanne to make sure we review your income, especially if you haven't filed 2022 taxes yet. And if you already have, and it may not work, so we make sure we give you the right information for next year, because it's only, what, 7 months away? 6.5.
Time is flying.
Yeah.
All
Okay.
right. So down payment requirements. Okay, so LAHD requires that the borrower contribute a minimum down payment of 1% of the purchase price from the borrower's own funds. So an example, you're purchasing a property for $700,000. Your minimum contribution is going to be $7,000, right? This is to make sure that you, as the homeowner, comes in with some skin in the game, right? So you don't want to have everything kind of pretty much paid for, right? So please be prepared for a minimum of 1% of your own funds of what you're purchasing, okay? LAHD will review the borrower's asset statements to ensure 1% of the down payment is coming from the borrower's own funds. Cash deposits will not be considered as source funds. That means that you cannot reach under a mattress and go put that money in the bank tomorrow and get into escrow on Friday and us be able to use that money as income, as funds or assets to utilize for this program. So in this case, if they're going to look for 6 months, you may want to put that money in there now if you are looking at it, right? Or look at receiving a gift from someone to offset that, because we have to be able to source funds, right? These are for money laundering purposes, etc. So be aware of that. Documentation will be required for all accounts deposited from friends, families that are described as loan repayment. So for an example, if your mother goes ahead and puts $5,000 into your account, we will now need a bank statement from your mother showing where those funds came from, okay? So anyone that is going to gift you, you're not gonna say borrow, gift you funds for the sake of this purchase, we will have to source those funds, and we do that by getting a bank statement from the person that is giving you those funds for this loan. Any questions about this slide before we move forward?
We have one more question.
Okay.
Crystal is asking, when do we pay back the loan, and is there interest that will be added?
Great question.
I think we should defer that question towards when we cover it, guys.
Yeah, that's what I was gonna say. I was gonna say Crystal's also jumping ahead, and we want to make sure you stay and get all the information, but we will answer that question, Crystal.
I want to be kind of clear on the down payment portion that we're talking about, as far as 1% coming from the borrower's own funds. That cannot come from a gift. Okay, that has to come from you. Also, for those people, 20% programs. I'm sure you guys might have heard of Dreams for All. Dreams for All became a nightmare for most because the funds were gone in 2 weeks, okay? So this is one of the only, if not the only, program that is offering 20% towards your down payment, okay? The reason why this is so important is because you're gonna be paying on 20% less, because of the 20% contribution. That also eliminates mortgage insurance. So on average, you're probably gonna save about $500 to $1,000 per month going with this program over other programs. So doing as much as you can to have that 1% contribution is going to be key. That's for those who may not that may not currently have it. So if you got to save it, cash out some money from a 401k, I would say do what you got to make sure you have your 1%, because it is required. It's not going to be refunded. It's something that you have to contribute on this program.
And
Thank you
Vita
for that
is
clarification.
saying 1% of 800,000 is only $8,000.
Right, and it's tax time, so I don't want to see no Vegas trips. I don't want to see no Tulum trips. That tax return may be your key to the home with this program. We can move forward. See with the next slide.
I don't want to say only $8,000 though. 8,000 is kind of a lot, but
We have one more question.
but you
Okay,
can
go ahead,
you
go
can
ahead,
raise it,
Joey.
people. It's possible.
Britt is asking, does the person gifting the money fall under the same requirement of having the money sit in the account for 6 months?
No, the person gifting the money will only have to have those funds in their bank account for 30 days. So we'll need a bank statement from them showing that at the beginning of that bank statement, you'll have a beginning balance, ending balance. We want to make sure that beginning balance shows at least the amount they're gifting you. But we do not need 6 months of their bank account, only for the occupying borrower.
Yeah, because Brittany was like, look, grandma ain't gonna give me 6 months of the statements. Awesome, thank you.
Okay.
Okay, so down payment requirements continue. Gift funds are not considered borrower's own funds. However, they may be included in the transaction as additional or as a other source of funds towards the purchase. Borrower's minimum down payment requirement must be in escrow prior to submitting the LAHD loan application to LAHD. Please note that the borrower may not contribute more than 1%. May need to contribute more than 1% towards a down payment to complete the purchase if all other sources are maxed and there is a shortfall in funds to close escrow. So let's give a quick example about that. So let's say, just use Ms. Britt for an example. Ms. Britt is in escrow to purchase a property for that $800,000, and she's in that tier 120, right? And let's say that her cash to close comes up to $10,000, right? And the program has covered all of the funds. She will need to bring that additional $2,000 into closing. So that's super important, but we are very, very good at structuring this up front. So when we're giving you these figures, they're going to be pretty hard on what you need to bring. But anyone in real estate will tell you that things happen and things change. But when we put you out there, more than likely you're going to know a good number in terms of what you're going to need to bring to get the transaction closed. Anything you want to add to that, C?
No, that was pretty good.
Okay.
That's fine.
Okay, so I'll take this one and then I'll shoot back to you. Down payment requirements continue. 80% asset rule. This is where it gets a little tricky. Okay. So we talked about the 1%, but that 1% can be more if you're sitting on some racks, okay? So borrower must contribute 80% of all liquid assets in excess of $20,000 towards the purchase of the home. Retirement assets are exempt from this rule. If 80% asset rule applies, the minimum down payment requirement will be greater of the 80% of the asset rule or 1% of the purchase price. Here is an example. See, I'll let you take this example because you taught me this.
If a borrower has $25,000 in non-retirement liquid assets, the borrower will be required to contribute $4,000 towards the purchase price of the home as shown in the example below. So $25,000 minus the $20,000 equals $5,000, and 80% of that is $4,000. Special note, the above is the minimum contribution required. The borrower has the option to contribute additional funds towards the home purchase. So there's a few ways that you guys could also, they're asking for all assets. So if you truly have like $100,000 in the bank, yeah, you got to figure out a few things. Okay. Number one, if you want to report all those assets, that's your business. Number two, if you don't exceed it by 20,000, then this really does not apply to you. And if you do have more than $100,000 in the bank, then you may just want to look at putting 3% or 5% down and not using this program at all. But to each his own. Yeah,
and that's something we talk about when we talk one-on-one, talking about the best option for you and why we work with so many different programs, because every single person's situation will be different. Okay, I don't see any new questions. So see, we can go to the next slide. Okay, see, this one's on you.
Okay, financial reserves. Borrowers must have liquid financial assets that can be used for reserves post-purchase for unanticipated emergencies or unforeseen expenses. The amount of liquid cash reserves required must be at least 1 month of the total housing expenses, including principal and interest, insurance, real estate taxes, any association dues, private mortgage insurance. So basically, you must have at least 1 month of your mortgage after closing still available to you to meet the liquid financial requirement.
Right. So an example, if your mortgage payment will be $4,000 at the end of closing, we still need to be able to show $4,000 after you've made your contribution to the deal.
Sure. Acceptable sources basically includes your checking, savings account, investments in stocks, bonds, mutual funds, CD accounts, money market funds and trust accounts, retirement accounts that are readily available to be converted to cash, gift funds. So keep in mind, this is for the reserves, okay? Because this is different than the money that you can use towards purchasing the house. When they talk about assets used towards purchasing the house, the retirement account is excluded from that $20,000 rule, okay? But on the liquid financial requirements, you can use your retirement account as liquid reserves, okay? I'm not sure if that helped or confused some people, but I just want to throw that out there. All right, so I'm gonna
That makes sense. That makes sense. So an example, you have a 401k and you have funds in that 401k that's in that exceeds what your monthly mortgage payment will be. That can be used to satisfy your reserve requirement.
Exactly. Okay. All right, so looking at the minimum credit score needed for this program is a 660, okay? Also, you have qualifications in regards to the ratios, also known as a debt to income ratio. You must have a minimum of a 36% debt to income ratio and a maximum of 45% unless you have 3 approved compensating factors. You can go up to 50% of your income. So what that basically means is if you make $10,000 a month and you can use 45% of your income, all of your bills, including the mortgage, needs to be below $4,500, which is 45% of that $10,000.
Right, and I want to add in too, because when C says bills, there are bills that, and when we speak of bills, we mean bills that show up on your credit report. So credit reported bills. So your car insurance is not going to be factored into this. Your life insurance is not going to be factored into this. So we're looking at credit debts. But again, if you we talked a few slides ago, if there's another regular payment that you're making that doesn't show up on your credit report, that can be added into your debt to income ratio. But in essence, we are just speaking about credit debts when we talk about this debt to income ratio.
Okay, any questions about credit or the debt to income ratio? If not, we're going to keep it pushing. All right. So on this slide here, it mentioned that you can go up to 50% of the debt to income ratio if you have 3 compensating factors. The 3 compensating factors could be any of these 3 things: 700 credit score or higher for at least 1 borrower, investing more than 3% of your own funds, having monthly debt less than $50 per month and total debt less than $2,500, 5 years on the same job or in the same line of work, cash reserves of at least 3 months PITI after loan closes. PITI, for those of you who don't know, that's principal, interest, taxes, and insurance, okay? So that's basically your mortgage payment. If you have 3 months of your mortgage payment after the loan closes, that's considered a compensating factor. Also, low payment shock. If your payment is no more than 20% of your present housing payment, okay? So if you have 3 of these compensating factors, we can go up to 50% of your income to help you qualify for this program.
Right. And what that means, I want to add before we move forward, what that means. So just to give you an example, the difference between qualifying at 45% of your income versus 50% of your income could easily range between another $50,000 to maybe $75,000 in buying power. So it is significant, right? In terms of that. So if, if we can get 3 out of these 6 compensating factors to get you to qualify for, that could increase your buying power as well.
Okay, and then LAHD may calculate debt differently than the first mortgage lender. For example, LAHD will not include debt from a non-borrowing spouse who claims they receive no income. Excuse me. LAHD will include debt from a non-borrowing spouse who claims they receive no income. LAHD will include the full amount of any collection debt as monthly payments unless the borrower can provide proof that the collection agency has agreed to monthly payments. So that basically means for any collections you have, you want to make sure you have payment agreements on those collections. LAHD will include monthly payments of revolving debt regardless of the remaining number of months to pay off the debt. If an installment loan has less than 10 months if an installment loan has 10 months or less remaining on the loan, LAHD will not count that debt. LAHD will include all monthly payment amounts from loans obtained from retirement accounts such as 401k loans.
Now, I want to add one thing in there. Is everyone aware of the difference between revolving debt and installment debt? Is everyone aware of that? I'm going to tell you anyways, right? So the difference is revolving is like a credit card, right? Credit card is a revolving debt. There's no end date. You use it, you pay it, you use it, you pay it, right? It's revolving. So no matter what, if there is a $50 balance on your JCPenney card, that debt is going to be calculated because it's revolving. You can use that again. Now, an installment debt is something that has an end date. So you purchased a car, not leased the car, but you purchased the car, and you have 8 payments left. That will not be factored into your debt to income ratio because after those 8 payments, you will no longer have that payment. So that's the difference between revolving and installment. So I wanted to make sure we're very clear about that. Installments could be a personal loan that has an end date. Revolving is something that's going to continue as you use it. Okay. I hope that's helpful.
Okay. So to give you guys an example of the MIPA 120, this is basically how the program would work, okay? Then we'll get into repayment here shortly. So for the purchase price, if you're purchasing a $600,000 house, and we are assuming about 3% towards the closing costs, which means the total funds you need is $618,000. So your first mortgage is $497,000. Give me 1 second here.
Now you're on the right path.
Okay, yeah, I just want to make sure because it kind of threw me off the way they structured it here. So the first mortgage is $497,000. That is because they're looking at putting in the $97,000 here into the down payment, essentially, along with your minimum contribution, along with the MIPA closing cost portion. So MIPA will give $115,000. That's basically the difference of these two numbers in red that contributes towards the $618,000. So that means that you're paying on $497,000 as your mortgage payment, and that your minimum contribution was the $6,000 to get into this home.
And I want to add something on that too. So let's for an example, if you were purchasing the same $600,000 and you were putting down 5%, your loan balance will be higher, your first mortgage, which means your payment will be higher. So this is a program that not only you're going to get the assistance to get in the home, but you're going to be making a payment on a lower mortgage balance, right? Which essentially is going to make your mortgage payment lower than if you were to put down a minimum down payment. So this may get you to qualify for a little bit more because your loan limit is going to be a little bit lower by utilizing the program.
Okay, and I want to talk about repaying. Okay, so the payments, so when I give you this 20% down, it's considered deferred, requiring no monthly payments. There's no interest, 0% interest on that money. Shared appreciation applies, which we'll go over shortly. The LAHD loan and shared appreciation are due upon the sale of the property, title transfer, first mortgage repayment, when the borrower no longer occupies the property as a primary residence, or in 30 years as a balloon payment or other repayment trigger. So basically, if you sell the property or if it transfers title, they list first mortgage repayment because this money can become due if you were to refinance, okay? And the borrower no longer occupies the property as a primary residence. Not sure how they would know that, but that is a repayment trigger, or in 30 years as a balloon payment or other repayment trigger, okay? So basically the repayment triggers are transferring title. Refinancing of the first mortgage is allowed by LAHD under certain circumstances. Borrower may submit a subordination request to LAHD loan portfolio unit. So basically, once you get this property and the city gives you 20% towards your down payment, if you want to refinance your house to get into a lower rate potentially, you have to apply in order for that money that you owe to LA City. So if you don't want to have to repay it, you have to subordinate that loan, which you have to submit a request to the city of LA in order for you not to have to repay the money they gave you, so that you can refinance your first mortgage and take advantage of a lower interest rate. Okay.
Right, and then let me give you guys a quick example. Let's say Ms. Jody purchases this property this year for $600,000, and she has an interest rate of 6.5%. And 12 months from now, interest rates have gone down. Our economy has recovered, and interest rates are 4.5%. So what Ms. Jody would do is she would go to the link that's provided and apply and say, I would like to refinance my property without triggering repayment. She cannot take any cash out of the home. This is called a rate and term refinance. Okay, this is not a cash out refinance. If you cash out, they want to be cashed out. Okay, so this is just to lower your rate, to lower your payment, to put you in a better financial situation. So they want to keep you in the property, right, as well. So this is why they're still allowing this. A lot of programs have no subordination whatsoever. If you want to refinance, you're going to pay us back. So there's at least a glimmer here for you to be able to do so. But again, this is only to lower your rate, right? Not to take any cash out. Whenever you want to take cash out, they're going to want to be paid back. Okay. Back to you, C.
Hey, no problem. I'm going to speed through the rest of this. I just noticed we're at 7:06. I want to respect everybody's time and continue to take some questions here. So just to be clear about what you would owe back, this is shared appreciation. Appreciation is the difference between the original purchase price and the greater of the future sales price or the appraised value. So if you bought a house at $600,000 and that house, when you went to go sell it, let's say, is now worth $700,000, you appreciated $100,000. So once again, that's the difference between your purchase price and the sales price is $100,000. The way that the appreciation work, the LAHD's percentage share is the percentage of the loan to the total purchase price of the property. So let's just say, for example, you used 20% of the down payment from the LA City. Well, then your percentage share is 20%. So if your house appreciated $100,000, then you would owe LA City back the 20% they gave you to purchase the house and 20% of that $100,000. Okay, 20% of $100,000 is $20,000. The other $80,000 is your portion.
And thank you, C, for explaining that, because a lot of people say, well, I don't want to give up my equity, right? So they don't want your equity. Equity is what you've paid down, right? So Ms. Jody's in that property for $600,000. She's put down, she used 20%. She's at that $497,000. In 10 years now, she's down to $400,000. So she had $100,000 in equity. They don't want that. They want the money that they gave her, that $97,000 towards her down payment, and 20% of what the value has appreciated, the home has appreciated that. So not the equity, the appreciation. So there is a difference. And I want to be very clear about that, right? So a lot of people, I don't want to give up something. Well, you don't want to give up something if you have nothing, right? So utilize this program, because even an example that Carlden just gave, you're keeping 80% of the appreciation, you're getting 20%. And you're keeping all of the equity that belongs to you in the property.
And this would be a good time for me to tell you, I personally predict that most people, unless they're utilizing a program like this, are going to have trouble purchasing a home. Home prices right now are still the highest they've been. We had a pandemic happen where rates were extremely low. Interest rates have now gone up, making it very hard for people to afford a home. So this program helps you with the affordability. But the reason why you kind of want to use this program at a time like now is because some sellers, because affordability is a problem, some sellers are having trouble selling their property. You kind of need that to be the case, because if you're using down payment assistance, we didn't cover this yet, but this program could take up to 45 to 60 days to close. So if you're hoping to get a seller to accept those terms, that you're going to use down payment assistance, you're only going to put in 1% of your own funds, and you're going to take 45 to 60 days to close. Well, there's other loans where somebody's putting down their own funds, not using a program, can close in 21 days. I just closed one in 12 days, right? So they could close extremely faster than this. And we don't have to worry about whatever it may be required if the LA City runs out of funds and stuff like that. So if you want to take advantage of a program like this, you want to do it in a market like this, where the sellers don't have 20 people lined up outside of their house like we saw during the pandemic. Okay, and we saw that briefly again. Rates dipped by 1%, and we also saw the Dreams for All program hit, and we saw people lined out outside of open houses. That is not going to be helpful for you if you're hoping to get a seller to accept this loan above somebody who has their own cash. So that's kind of why we waited to produce this particular workshop, is because the timing is perfect for something like this if you wanted to use this to get into a house, okay? So going back to Otis's point as
Can
well.
I share something, please, Carlden?
Yeah, go ahead. Abida, I was coming to you.
Sure, go ahead.
I think that there's so many negative associations, and people are uninformed about the programs, and a lot of agents are not educated about the program. So it is important that representation, whoever you're working with as your realtor, is confident about the program, has all the information so that they can transfer that over to the agent to educate them so that they feel confident about using the program. Lots of times it's just about communicating. It's just about how you present it. And everybody knows that the market is inflated. Most people want to help you out. Most people will work with you, but it's a matter about closing that education gap so that they feel confident. So I just want to throw that out there. It's typically negatively perceived, but it's all about shifting that mindset with educating them so that they feel confident about it.
Absolutely. And to add on to that, and that's exactly why when Joanne mentioned at the beginning, why we call that listing agent on your behalf, so that they're comfortable with accepting this offer, because I've spoken to Carlden, I've spoken to Otis, I have his number directly. They don't want to be on the hook and say, well, I don't know what's wrong with this deal, right? Beta is a listing agent. She doesn't want to not ever be in the know, right? And so that's what we do to give you the absolute best chance possible, so that, hey, yes, this person is utilizing this program, but hey, I'm Otis, I'm representing her. This is my direct number. You can contact me at any time. I'll give you weekly updates. And that makes them a lot more comfortable with moving forward with this program or any other program that may go longer than a regular contract time of 30 days.
Right. So thank you for that, Otis and Beta. So bottom line on that, this is a good time to utilize a program like this. And the second thing is in regards to shared appreciation. If you don't have a home right now, and this program is going to help you get one, right? Typically, whatever you would repay back to the city, you'd have saved from your mortgage payment. So let's just say that this program helps save you $1,000 a month. So at the end of the year, you're saving $1,200. You keep the house for 10 years, you saved $120,000. So if you have to repay the city $100,000 and $20,000 for your appreciation, they really help make you a homeowner, and you still get to keep the other 80% of the appreciation, and you get to keep all of the equity that you paid into the mortgage. So this program, I think, is great for those people who, first of all, you might not be able to afford without this program. Okay, so that's one of the biggest things. It helps make it affordable. And number two, it doesn't take everything, because some of these loan programs, they'll ask you for an interest rate to be associated with the first mortgage, or a higher interest rate on the loan, on the money on the first mortgage. So there's certain programs where the interest rate to get down payment assistance is 2% higher than a normal interest rate. On this program, they'll allow you to still keep your interest rate the same. So I just wanted to throw out the positive things about this program, because some people may say, why would you do this? But I've seen payments as high as $6,000 a month. I've seen some 4,000. Some people can't afford that. So if you take a program like this that gives you 20% and it chops off $1,000 from your mortgage payment, that may make that 4,000, 3,000. That may make the difference of you being able to afford or not. So I just want to make sure I highlight that about this particular program. I'm going to try to skip some of this because we're running out of time. And one of the most important things that I think I should, this slide goes over a shared appreciation, which we kind of discussed already. And we're still here. Keep that in mind. Otis, Joanne, we're here for you. Give us a call if you guys have any questions. But on the LIPA program, if you're low income, they will require a inspection. And there are requirements in regards to that if you're on the low income side. What else do you need to know? Sorry, just trying to give you the highlights. For MIPA, if you're moderate income, you do not require a property inspection. However, we always encourage any buyer that's getting a house to do an inspection. All properties must undergo a termite inspection. You must have a basic home warranty policy, and so those are two of the things. Basically, the city is giving you money to help you purchase a home, but they want to make sure that that home isn't infested with termites or, structurally bad or anything like that. So that's kind of why they have these particular requirements, because they're investing in you, but the collateral is the property. So they want to make sure at the end of the day, if you don't pay your mortgage, they'll get their money back because they invested in a sound property, essentially. This portion covers the warranty. It must also include a water heater, heating, air conditioner, oven, stove, and range. That all must be included in the home warranty. We also offer other down payment assistance programs. So if you saw something up on here that was not favorable to you, the biggest issue for most people is the income limit. We do have programs that do not have an income limit. Cal HAFA has a higher income limit of 180. Luther Burbank offers a 1% down product where if you're in low to moderate income census tracts, you will have no income limit. Golden State Finance Authority has an FHA loan that has no income limit. Now, all of these programs do not give as much as the LAHD program does. But if that's your barrier, is a down payment, there are other programs to help you get there. So I want to make sure we do say that, as well as we offer non-QM. I'm going to give this part back to Otis.
Yes, non-QM. Before we end, I'll make sure everybody's still awake. One in the chat. Have you ever heard of a non-QM loan? One in the chat. One in the chat. Let's see. Who's heard of a non-QM loan? And Beta, don't answer. Okay,
Why not? I
two in
can't
the chat.
answer.
Okay, perfect. Okay, great. So non-QM, right? So there's QM, which we're familiar with, right? FHA, VA, conventional. Those are all QM loans. QM stands for qualified mortgages, which means they have a set of guidelines, rules, and compliance that you must follow. The biggest is the ability to repay and how that's calculated. Right, so check stubs, tax returns, etc. Right, with a non-QM loan, it follows a lot of those same guidelines, but not in the terms of repayment. So a lot of people have heard of a bank statement program. That's a non-QM loan. You can't get a bank statement FHA loan or a bank statement conventional loan. These are non-QM loans. So let's take, for an example, we have Ms. Beta. She is a realtor, right? And so she wants to qualify for a bank statement program. We can look at 12 months of her bank statements and utilize that as her income because she doesn't have regular paycheck stubs. That's a non-QM loan, a way to qualify for you. One of the ones that's becoming more and more popular in this non-QM loan is the DSCR loan. And this is great for people who want to start out investing in investment properties. This is for an investment property purchase. It's not your primary residence. You are not going to live here, but you want to purchase an investment property. What a DSCR loan is means the debt will be covered by the rents that you receive, right? So for an example, you're going to purchase a property and your mortgage payment is going to be $3,000 on this investment property. As long as that property can rent for $3,001, you can qualify for this particular loan program. So I will tell you on these particular loan programs, because they're deemed more riskier, they typically have a little bit higher of an interest rate than what your QM loans would. And the down payment is also a little bit higher on a lot of these programs than your standard FHA conventional loans are. But for without a doubt, it's becoming a larger and larger pool of loans being done in our industry. I just want to say in 2022, it represented 17% of the loans. That was up 7% from the year prior. So as the economy grows and people are earning money differently, not everybody has a job. That doesn't mean they're not making that coin, that there are other options for them to get into a mortgage, right? So that's what non-QM is. I would say I'm the non-QM specialist at Monarch Mortgage, but don't let Carlden fool you. He's very, very good as well. So if there's programs that we talked about today, down payment assistance that doesn't really fit you, and there's something else that we need to talk to you about, there's tons of things that we offer. So if there's any questions, we'll entertain them now. Again, I want to thank you all for staying with us the whole time. I think everyone stayed with us, see the whole time. So this is good. We appreciate you guys, and we'll entertain any other questions. Feel free to put in the chat or come off of mute and ask your question. Joanne, do you see any questions in the chat? You're on mute.
Well, we kind of wait.
Just responded to Stacy. Just so everyone knows, we will be sending out a whole list of cities tomorrow morning, right, Carlden?
Yeah.
Correct. Yeah, you guys, every registered attendee will get a copy of the cities. So then that way, that and also some of the income stuff. But I can't stress enough, please reach out to us when it comes to the income. If you're not within that program, we can definitely help you with another program as well.
I have a quick comment.
Yeah, go ahead.
Can you guys hear me? Phil?
Yes. Well, we could hear you. Where you go? Did she disappear?
We just lost her.
Okay, in the meantime, Danielle has a question.
Go ahead, Joe.
For a non-QM loan, is there a minimum requirement that should be in your bank account?
No, there is no minimum requirement. We have to look at the type of non-QM loan because there's different types of non-QM loans. There is no minimum that you need to have in your bank account. Because let's say, for example, if we're doing a bank statement loan, we're looking at the income that's coming in, right? And obviously you're going to have the down payment somewhere. So that down payment can come in the form of a gift on a non-QM loan. It can come from, if you're utilizing like a 401k or retirement account, you can utilize that for down payment. But there's no set amount of money that you must have in your bank account for a non-QM.
Oh, okay, got it.
And we
I'm ready.
We have our link tree, our QR codes here for you to reach out to any of us. So feel free to take a snapshot of those. Carlden put his information in the chat. Joanne, make sure you put your information in the chat. I as well put my link tree information in the chat. Any of us that are available to help you, we most certainly will. So please make sure you reach out to us to talk about your particular situation and see how we can get you to homeownership. Did who fell off that had a question? Did they come back?
I wanted to just make a comment, Otis.
Go ahead, Vita.
It's very common, like a lot of people do get discouraged with the process. And so there are a lot of steps. There's a lot of documents that you have to provide throughout the process. And it can sometimes be a headache, but I just want to encourage you guys that it is so well worth it in the end. And while you're going through the process, it's just a limited amount of time, 30, 60-day escrow, while you're through in escrow. But once you close the loan, like all of that will be behind you and it'll be so worth it. So I just wanted to share, like, to go through the process, go through the steps, don't be discouraged.
Thank you for that, Vita, and you're 100% correct. I spoke to a gentleman I did my very first loan on just 2 days ago in 2018, right? He purchased his first condo. And when I tell you him and his parents, because they were co-borrowers on there, they were, Otis, if you call me one more time, I'm going to lose it, right? But when I talked to him the other day, he was like, man, I'm just so happy I made the decision to buy the home, his property, because he went through that boom of appreciation that we went through over 2020, 2021. His property is now worth $150,000 more than he purchased for it. He said, I don't remember you even asking me for those things. So remember that something that this is important. It's going to feel strenuous, right? If it was easy, everybody would do it, right? So please have your mindset in the right place, but nonetheless, you will have a supportive team behind you to make sure we get you through to the finish line. So thank you, Beta, for adding that, because it is very taxing on the mind. Awesome. Thank you, Ms. Jody, for joining us. We appreciate you as well for sticking on the whole time. And listen, your head nods made me feel like we are on it, right? So thank you, Ms. Jody. I appreciate it.
Okay.
Thank you, Stacey, as well.
Crystal,
And I want to say one last thing. Thank you to all the people that had their camera on. I haven't been on a Zoom and seen this many people in a long time. So shouts out to all of you guys that had your camera on, because it's tough talking to blank boxes. So we appreciate you.
Now, I want to quickly say I couldn't see nobody this entire time because I'm sharing my screen, and I was disappointed in that. But I've been doing my best to act like y'all still here listening.
okay. Crystal is asking, how long is the program being offered?
Great question. This program is ongoing. A lot of people think this program is new, that this is something new that's come out. This program is not new. It just hasn't been the right timing, like Carlden stated, in the markets in which we were in, where we were moving really fast. If you submitted an offer in 2021 saying 60 days, forget about it, right? It wasn't even an option, right? So the timing is important now. So this program is it's not something that goes away. It is funded annually, right? So the program can run out of funds. I don't remember the last time that it has, but also the timing wasn't there, right? So now the timing is here to utilize this program. It is a very likelihood that it can run out of funds. So if you're even thinking about it or close to it, please get with one of us so we can get your application reviewed and see if we can get you qualified so you can get out right now. But right now the funds are plentiful, so I wouldn't be concerned about it going away right now.
I mean, I do want to just add that on the moderate income, so the higher your income, the more likely it is for the program to run out of funds, because I historically have seen the moderate income run out of funds first. Low income, you'll typically be fine if you're in that income bracket. But if you're in a moderate income bracket, if funds are going to run out, it's going to be from that tier first. So I don't want people thinking this is a program you can sit on and apply for next year or something like that. You need to get on top of programs when they're here, because we really can't tell you if they'll be gone. I thought Dreams for All would be here for 2 to 3 months. It was here for 2 weeks. Okay, so take advantage of it while we know it's here and while they're funded. Even though, of course, if you have other reasons why you have to wait, then that, it is what it is.
Yes, Kimberly, you have to repay it, but we're gonna we'll make sure we'll send out this video. We'll maybe put this on our YouTube page. So we'll send out a link to all the attendees to rewatch the video. If you missed that part where we detailed it, but long story short, yes, it does have to be repaid over time. There is no interest. And Beta, I believe, I'm not sure of the fiscal year that they are on right now as it funds. That's something that we can check on and let you know what month it replenishes for their year annually. All right, any other further questions, comments, concerns? Carlden, Joanne, anything you guys like to say in closing?
Just want to say thank you all for attending. We really appreciate your attendance. Let's make at least 25% of you homeowners, okay? We didn't put out the links for our applications, so we can definitely add that on here if you like. If you were on the QR code does have that information so you can apply. And that's it for me, Joanne.
Likewise, thank you everyone for attending. And if you have any Spanish speaking borrowers and or are Spanish speaking, please give me a call.
Awesome. Again, thank you to my team. We really appreciate you, all the attendees, for coming and staying the whole time. Shouts out to each and every one of you guys. We will send out some follow-ups to everyone that attended the meeting tonight with the areas for the where the program can be used, as well as some other details that are important. So if there's no further business, again, thank you all. We appreciate you all, and let's see you in the home soon. I'm at the housewarming.
All right,
Thank
guys.
you.
Everyone,
Thank
thank
you.
you.
Thank you.
Bye,
Goodbye.
everyone.
Bye-bye. Have a good evening.
Thank you. I have one question. Did you say you were going to send out the link for the application?
Yeah. We have, yeah. I think I have the application for you, Sandra. Call me tomorrow.
Okay, I'll call you tomorrow.
Okay.
Thank you guys. Bye. Good night.
Bye, Sandra.
Bye.
Good night.
I can finally see the attendees as they leave the room. Gotta every to say thank you. Anita Jones, thank you for attending. We got her in the house.